Unless you live under a rock, you probably saw that the Chiefs repeated as NFL champions this past Sunday. What a lot of people don't know is that this, with the Taylor Swift appearance, has a lot to do on what's going to happen to the market this year. Alright, not really. However, I have been reading Random Walk Down Wall Street, and in chapter 6, he mentions some things that happened that seem to be tied to the market, but in reality, they're complete coincidences. One of them is that historically, the winner of the Super Bowl has determined whether the market goes up or down. So in this video, I'll mention my favorites, but before that, let's do a quick review about what correlation is. I'll make these very simple because I hated statistics and I definitely don't understand the formula. But think of correlation as a relationship between two things. The correlation coefficient can go from -1 all the way to 1. A positive correlation coefficient means that the two items have a positive correlation. So as one variable increases, the other also increases proportionally. For example, the weather and the sale of sunglasses has a positive correlation. As the weather increases, more people buy sunglasses. Now, a negative number, you guessed it, has a negative correlation. This means that as one variable goes up, the other one goes down. Following the weather example, as the weather increases, sales of winter jackets decreases. And then lastly, a score of 0 or close to 0 indicates that there's no correlation. So the weather has absolutely no correlation. It has nothing to do with stock prices. Now that we quickly reviewed that, I have to remind you something that you've probably heard before, and that is that correlation does not imply causation. Just because some variables are correlated does not mean that they're related. And this is the case with the events I'll mention now. In reality, they have absolutely nothing to do with each other, but interestingly enough, by coincidence, they're historically correlated. So let's start with the Super Bowl indicator. Before 1970, there used to be two football leagues, the NFL and the AFL. In 1970, they merged, and the AFC and the NFC were created. Now, the important caveat is that this indicator uses the old classifications. If a team that was originally in the AFL won, that would signal that that year there was going to be a bear market. And if a team from the original NFL won, that would signal a bull market. This distinction is important because even though the Steelers are in the AFC today, they were originally in the NFL. So they count as a team from the old NFL. Now, the crazy part is that when this was introduced in 1978, there had been 12 Super Bowls and the indicator had predicted the market correctly in 11 out of those 12 years. And if you fast forward to today, the indicator has predicted the correct winner in 40 out of the 57 times, which is 70%. So you could say that there's some correlation there, but again, this is completely random. And you can see this if you look at the past 20 Super Bowls where the indicator has only been correct 6% of the times. So as you can see, there's no relationship. It's just a funny coincidence. But for fun, I'll keep track this year. Since the Chiefs won, they're in the AFC. So that signals that we're going to have a bad stock market year. So I'll make a TikTok at the end of the year to see the results. So the next one is the January effect. This says that in January, stock returns are way higher than in any other month of the year. But it's kind of crazy because there was a study from 1904 to 1974 that showed that stock returns in January were 5 times higher than any other month in the year, especially in small cap stocks. The explanations for this could be that people sell a lot of stock in December, so they're able to claim that loss and reduce their tax liability, and then they buy back the stock in January since it's a new year. Another reason could be that people get paid bonuses early in January and they invest most of their bonuses in the market. And also maybe New Year's resolutions. People just want to invest more in the New Year's and they wait until January to do that. However, like the Super Bowl indicator, this one has been dying as of late. And in the past 30 years, it's only been correct 57% of the times. So that's basically completely random, almost the same probability as flipping a coin, but it used to be very big in the 1900s. Next up, we have the dogs of the Dow. The Dow Jones is an index that tracks 30 of the biggest companies in the United States. This theory says that if you pick the 10 lowest performing stocks of that index from the previous year and you invest in them, you will outperform the market on average. In 1991, a guy called Michael Higgins released this theory, and if you applied it back to 1920, you would have outperformed the market by 2% per year, which is insane because over a period of 40 years, it is more than 100% 10% return on your money. I'll put the $10 of the dollar here just for fun, but just know that since the book came out, this strategy became too popular for its own good. A bunch of institutional investors started using it, and since then, sadly, the market has outperformed it as well. But at least it seems that this one did work for most of the 1900s, so that's pretty interesting. And then the last one I'll mention, which is absolutely ridiculous, so I won't spend too much time on it, is the Hemline Indicator. If you don't know what a hemline is, because I didn't, is how low the level of a skirt is. And this theory says that in a given year, if you look around and women are wearing skirts that go below their knees, the market's going to perform negatively. And if you look around and what's in is for women to wear skirts above their knees, the market is going to do well. I'll put the graph here shown in the book. Again, absolutely insane. If you track it back historically, it does make a little sense. Again, correlation does not mean causation, and obviously this means nothing. But these are my favorite theories mentioned in A Random Walk Down Wall Street. Comment down below if you've heard anything else, subscribe, and we'll see you next Wednesday for a new video. Peace.